The law is one of our most sacred institutions as a society. It stands as a testament to the indomitable will of humanity to strive for order out of a universe of chaos, even when it is hard. The Lady of Justice truly is blind and has no... While definitely not a Wall Street blockbuster like private credit, litigation finance is set to take off over the next decade. But how exactly big is it? According to the law firm Brown Rudnick, there's over $39 billion in capital in the global litigation finance market. For America alone, according to the Practicing Law Institute, there's $18.9 billion in assets in litigation finance. For context, this puts the American litigation finance market at a similar size to the market cap of a company like Southwest Airlines, Zillow, or Best Buy. Using the growth projection from Practicing Law Institute, there will be $54 billion in assets in the American litigation finance market by 2035. For a similar comparison to earlier, this would put the American litigation finance market at a similar size to today's market cap of a company like General Motors, FedEx, or Travelers. By now, I hope I've convinced you that this is a pretty serious market. But what exactly is litigation finance? Prior to doing research to this video, I had only ever heard of it as a boogeyman mentioned by some startup marketing company trying to get me to buy some data. That's not particularly a great introduction. Additionally, if you type litigation finance into the search bar for YouTube, you don't really get any interesting results. That means we're first the party here, which does give us first mover's advantage. But that also means we have to do a lot of dirty work in finding our sources. The most clear introduction to litigation finance that I could find comes from Lexshares, a commercial litigation finance company. They start off pretty strong with a quote from New York Supreme Court Justice Eileen Branston. Litigation funding allows lawsuits to be decided on their merits and not based on which party has deeper pockets or stronger appetite for protracted litigation. Okay, so litigation finance sounds pretty good, at least from that quote. But let's cut the fluff and see how it actually works. In their section titled, "What is litigation finance?" they state the following. Litigation finance, also called litigation funding or legal financing, is the practice where a third party unrelated to the lawsuit provides capital to a plaintiff involved in litigation in return for a portion of any financial recovery from the lawsuit. In plain English, that just means litigation finance is the practice of an investor providing capital to help someone sue another person for a cut of the financial reward at the end of the lawsuit. You might be thinking, okay, so what? If the plaintiff loses the lawsuit, they still will have to pay a return to the litigation finance company. Surprisingly, no. As Lexshares states later in the same Finance 101 section, most commercial litigation finance companies do not provide traditional loans. Solutions are instead structured as non-recourse investments, which means that the funding recipient owes nothing if the lawsuit does not result in a recovery. Okay, that sounds like a pretty sweet deal. But are defendants, the party being sued, just left out to dry? Not entirely. There are some litigation finance options available on what is called the defense side of litigation finance. Omni Bridgeway, another litigation finance company, has a blog post on their site called "A Primer on U.S. Defense Side Litigation Finance." In it, they define the main types of defense financing. There are three primary forms of defense financing available today: the hybrid portfolio, revenue sharing, and reverse contingency models. All are non-recourse, meaning the funder is repaid and receives a return only if the case resolves with a success for the defendant. Each model can play a role for the right kind of case, but the reverse contingency applies most broadly to the most types of cases. Hybrid portfolio is niche and complicated, so we're just going to skip over that. The simpler of the defense options appears to be the reverse contingency. As Omni Bridgeway puts it, the reverse contingency acts as a success fee. As with typical litigation finance, the defendant only pays the success fee if litigation resolves in their favor. And since the litigation finance company needs to make a return to justify the risk providing capital, if the success fee is triggered, the defendant will repay the invested amount plus a return. The other main defense side option is called revenue sharing. As Omni Bridgeway puts it, the funder's return comes from a percentage of revenue from the defendant until the agreed upon return is received. And as always, it's non-recourse. Now that we have a better understanding of the basics of litigation finance, it would be interesting to see what the results of litigation finance are. The largest case that I could find was definitely Edhen Park and Peterson v. Argentina. That's right, litigation finance was used to sue an entire country. Citing an excellent write-up done by WSC Legal on this case, the troubles began in 2012 when the government of Argentina acquired a 51% share of YPF, the nation's largest oil and gas company. When Argentina became the majority shareholder, the government stopped dividend payments and shifted earnings away from producing shareholder value. This adverse move against shareholders led to the inability of Peterson companies to service their outstanding acquisitions loans, ultimately resulting in them filing for insolvency protection in Spain. Peterson wasn't alone, as multiple other minority shareholders were negatively affected. This led to them making a lot of noise. So, naturally, a group of people, including a company that filed for insolvency protection in Spain because of Argentina nationalizing an oil company, acquired litigation financing from the American fund Eton Park and the English fund Burford Capital. Eton Park went bankrupt during this case, which led to Burford Capital to reap most of the rewards of the final ruling. Now, the Americans weren't out of the game when Eton Park filed for bankruptcy. It turns out, because YPF had its shares listed on the New York Stock Exchange, the plaintiffs were able to file their claims in the Southern District Court of New York. This led to the 2023 ruling of Judge Prescott finding Argentina liable for failing to offer to purchase shares from the other minority shareholders when it acquired YPF in 2012. But how much did Burford make out with? According to Reuters, citing a press release from Burford, before interest, Peterson's claims could be as high as $7.5 billion, with Burford recovering 35% of that. Further, Eton Park's damages before interest could be as high as $900 million, of which Burford would recover 70%. These figures would put Burford's recovery at roughly $3.25 billion before interest. All of that drama hit the markets 2 years ago, so how much has Burford made out with today? An article from the Buenos Aires Times paints an interesting picture. It states that Burford's litigation costs came in at less than $17 million, which means theoretically the firm made a killing. But the person that Burford hired to talk with the government about receiving their payment hasn't met with the officials once. You might be thinking that Burford is really eager to get things going. They practically won the lottery and they're just waiting for their payout. But later in the same article from the Buenos Aires Times, they quote Chairman of Global Banking and Markets at HSBC, Gerardo Mato, stating, "We're waiting for the final resolution. Burford isn't in any rush on this issue. If we negotiate before, it'll benefit the government because it's going to have a discount on the debt. If it happens after, they're going to have to pay the totality of the suit." So will Burford collect on the settlement? I guess time will tell. But this just goes to show that how hard collecting can be, and just because one of these firms wins a very favorable ruling, it doesn't result in money in the bank for them. While most of the attention in litigation finance goes towards funding legal arguments, I feel the most interesting stories come from funding judgment enforcement. The Akhmadova v. Akhmadov divorce case was the most interesting case that I could find that I also feel is criminally underrated. A blog on the law firm Hausfeld's website did a great write-up on the specifics of the case and the involvement of litigation finance in the matter. The blog shows that in 2016, Farkhad Akhmadov was ordered to pay his wife Tatiana £450 million, which at the time was the largest matrimonial proceeding the UK has seen. Typically, we end the story with the judgment. However, collecting the judgment is really where the story got interesting here. Tatiana had to get funding from our old friend Burford to facilitate her recovery of sums already awarded to her in the face of the husband's contumelious conduct, assisted by others, in evading and frustrating the enforcement of the judgment debt. Miss Justice Knowles observed, without such funding, the wife would lose access to justice and the chance of recovering the monies awarded to her. An article on Nelson Law does a good job of breaking down the continuing spiral of this recovery. For a few years, Mr. Akhmadov voluntarily did not give Miss Akhmadova a penny. And in true Russian oligarch fashion, this led to legal action spanning numerous countries in order to receive the assets. Mr. Akhmadov got so creative that he even transferred his £340 million super yacht and his £110 million art collection into a trust in Liechtenstein. As you might expect, this wasn't just some little mistake made on Mr. Akhmadov's side. In WhatsApp messages shared with the High Court, Mr. Akhmadov said he would burn all of his wealth instead of passing it on to his former wife, to which his son replied that his mother didn't deserve a penny. Now how's that for malice? If there wasn't already enough in here to sound like an action movie, according to an article from The Independent, Miss Akhmadova supposedly employed an asset recovery team which included former members of the Royal Navy's Special Boat Service, which may have been used in recovering a helicopter and a speedboat. Things settled down pretty quickly though, because the most anticlimactic bit was a press release from Burford after it had received its payment. I suppose to their investors, it really doesn't matter what happens so long as they get paid, but in my personal opinion, I think they need to step up their marketing game here. From Burford's press release, as of July 16, 2021, Burford had received its full cash entitlement of approximately $103 million in respect to the Akhmedov matter. Ultimately, Burford expects the matter to have generated more than $70 million of realized gain over the life of the investment. Doing some simple analysis would indicate that Burford spent roughly $33 million on the recovery. This would imply they received roughly a 212% ROI. Not bad. While I spent time talking about the successes of litigation finance, I wouldn't be doing my due diligence without talking about their failures. Sometimes, a litigation finance company doesn't do a good job of vetting a case's merits. In the case of Excalibur v. Texas Keystone, the litigation finance firm Consortium found that out the hard way. In a publication from the law firm Jones Day, the case brought forth against Texas Keystone was so bad that Excalibur's trial was considered a complete failure, and the prosecution had to pay 85% of the defense's incurred costs. The court called Excalibur's case speculative and opportunistic, and further described Excalibur's lawyers as objectively hopeless. That's pretty brutal. But do you know what else is brutal? When you thought your bag was secured, but then you lose it all. This is the case with the litigation finance company Omni Bridgeway in the class action lawsuit it helped fund against Seqwater. Citing Legal Funding Journal, originally there was a ruling in Omni Bridgeway's favor in 2019, which in 2021 was reversed by a court of appeals. This led to Omni Bridgeway's share price falling by 8%. The point of aggregating these stories was to help both you and I in understanding what the actual market looks like in litigation finance. It is a murky world, which makes understanding what these companies do pretty tricky. However, through the murk, we have seen successes ranging from the potential multi-billion-dollar blockbuster lawsuit against Argentina to the successful collection of nearly $100 million in a borderline action movie divorce case. Additionally, we've seen failures ranging from a firm losing more than its initial investment because it didn't vet a case well enough, to a firm winning a fairly large reward only for it to be taken away on appeal. Victories can't be taken for granted in this industry. So it is hardly surprising to see that returns in the litigation finance industry typically are way higher than the markets. These investments take a long time to return, if they do at all, and are non-recourse. Now, I know what you're thinking. How does all this impact you? It could affect some of your favorite content creators. Since the outcome of the hot sauce mogul and video gamer of the century Billy Mitchell v. formerly respected investigative journalist Carl Jobs case, there seems to have been an increase in interest in lawfare in the content creation world, which could lead to litigation finance gaining interest in the market. Hey, what's that noise? Now, if you're more investment-minded and you're looking for some alpha on your portfolio, litigation finance is fairly uncorrelated with the market, and you can actually invest in the industry. Our old friend Burford Capital is listed on both the New York Stock Exchange and the London Stock Exchange. Although I have to put an important disclaimer in here, this is not an endorsement from me to add them to your portfolio, as I'm not qualified to give financial advice. Additionally, as shown before, there are large risks associated with litigation finance, which should at least give you pause before adding them to your portfolio. In closing, I hope this video serves as a good introduction into the emerging market of litigation finance for you. If you found this video informative and you're looking for more deep dives into emerging markets, consider subscribing. I'd love to have you stick around. And most importantly, thank you for watching.